Bear markets are often viewed as one of the most challenging periods for investors. The market downturns, often accompanied by panic, uncertainty, and declining asset values, can tempt even the most seasoned traders to make impulsive decisions. While these market shifts may test your wallet, they primarily test your mindset. Unfortunately, many investors fall into emotional traps during these times, ultimately leading them to make decisions that harm their portfolios. In this video, we will delve into why these emotional traps exist, the most common mistakes investors make during bear markets, and strategies to help you stay strong and make rational decisions even when the market is down. The emotional roller coaster of bear markets. Bear markets evoke strong emotional responses. The decline in asset values triggers a sense of fear, anxiety, and even panic. When your investments start to lose value, it's easy to feel a sense of urgency to act, often too quickly and without a rational plan. This emotional turmoil often leads investors to make hasty decisions like selling off their assets at a loss to avoid further pain. At its core, a bear market is as much about emotional strength as it is about market knowledge. The fear of losing money can override logic and cloud judgment, making it difficult to stick to your long-term strategy. While bear markets are unpleasant, they are also an inevitable part of the investing cycle. The key to surviving and thriving during these downturns lies in maintaining control over your emotions and making informed, calculated decisions. Emotional traps. The pitfalls that lead to poor decisions. Fear of further losses, panic selling. One of the most common emotional traps during a bear market is panic selling. As the market continues to decline, investors often fear further losses and start selling their assets at the worst possible time. The desire to cut losses quickly becomes overwhelming, even if it means selling at a significant loss. This knee-jerk reaction may seem like a logical solution in the heat of the moment, but it is usually counterproductive. By selling during a bear market, you lock in your losses and miss out on the eventual recovery when the market rebounds. Tip: avoid making emotional decisions. If your assets are fundamentally strong and your investment strategy remains sound, holding through the downturn may be the wisest course of action. The herd mentality. When the market is bearish, it's easy to follow the crowd. The media often amplifies the panic, and you might see other investors selling off their holdings, which can create a snowball effect. In times of uncertainty, the herd mentality can be dangerous. Investors start making decisions based on the actions of others rather than their own research and strategy. This kind of behavior is often motivated by fear and the desire to avoid feeling left behind or making the wrong decision. Tip: stay focused on your investment strategy and avoid chasing the crowd. Just because everyone else is selling doesn't mean it's the right decision for you. Make decisions based on your personal financial goals and risk tolerance. Overreacting to short-term market movements. Bear markets often lead to sharp declines over a short period of time, which can cause emotions to run high. However, focusing solely on short-term market fluctuations is a dangerous habit that can cloud your judgment. It's easy to get caught up in the daily swings of the market, especially when those swings are in the negative direction. The key to success is recognizing that bear markets are temporary, and long-term investors tend to recover and profit once the market stabilizes. Tip: keep a long-term perspective. Market downturns are part of the natural cycle of investing, and history shows that the market tends to recover over time. Resist the urge to make drastic moves based on short-term volatility. Confirmation bias. During a bear market, it's common for investors to seek out information that confirms their fears. This is called confirmation bias, when you only pay attention to the news or opinions that align with your pre-existing beliefs. For example, if you're feeling pessimistic about the market, you might focus on bearish news and avoid more balanced or positive perspectives. This can perpetuate negative emotions and cause you to make decisions based on incomplete or skewed information. Tip: be aware of confirmation bias and actively seek a range of perspectives. Try to view the market objectively and consider both the risks and opportunities that may arise during a downturn. Trying to time the market. The desire to predict the market's bottom or top is a common emotional trap during a bear market. Investors may try to time their entry and exit points based on predictions of when the market will recover. While timing the market can be appealing, it is incredibly difficult to do consistently, even for experienced traders. Trying to buy at the bottom or sell at the top often leads to missed opportunities and unnecessary stress. Tip: focus on a long-term investment strategy instead of trying to time the market. The market is unpredictable, and consistent investing over time is often more successful than attempting to catch short-term movements. Strategies for staying strong in bear markets. Now that we've identified some of the emotional traps that can lead to poor decisions, let's explore strategies for staying grounded and making rational decisions during bear markets. Stick to your long-term plan. One of the most important things you can do during a bear market is to stick to your long-term investment plan. Bear markets are not the time to panic or abandon your strategy. Rebalance your portfolio. While it's important to stick to your overall strategy, bear markets can also present an opportunity to rebalance your portfolio. If certain investments have lost value while others have performed better, it may be wise to adjust your allocation. Limit your exposure to media and emotional triggers. The media tends to sensationalize market declines, which can exacerbate feelings of fear and panic. Constant exposure to negative headlines can cloud your judgment and cause you to make impulsive decisions. Take advantage of dollar-cost averaging. If you're investing during a bear market, consider using a dollar-cost averaging (DCA) strategy. DCA involves investing a fixed amount of money at regular intervals, regardless of market conditions. Maintain a strong support system. Navigating a bear market can be emotionally challenging, but it's important not to go through it alone. Seek support from fellow investors, mentors, or financial advisors who can provide guidance and reassurance during uncertain times. If you found this video valuable, don't forget to hit that like button and subscribe to the channel for more insights. Join our community, stay updated, and keep making smart decisions in your investment journey. Tap the notification bell so you never miss an update.